Good evening, everyone, and thanks for joining on a Saturday evening uh, for this webinar, which is the first of our virtual education webinar series titled as Equity as an Asset Class. Um, Basically, during the course of this webinar, we will be looking at equities as an asset class and how it's performed over the last 15 years, and whether it's been successful in the Sri Lankan context in both growing wealth as well as protecting your wealth against other market forces. And also, we'll be discussing a little bit about risks associated with investing in equities. There are a fair bit of misconception around risks in equities and how it could be effectively managed to protect your returns when you invest in equities. We'll also discuss a little bit about why this is a good time to invest in equities, why now in the current context. We'll talk a bit about getting exposure to equity through a self-managed portfolio as opposed to getting equity exposure through unit trust investments. And finally, we'll wrap up the session with a bit of discussion on best practices that you can follow whilst you create your equity portfolio. In terms of the format of the call, we'll have an initial presentation which will run for about 30 to 40 minutes, following which we'll have a question and answer session for about 15 to 20 minutes. Feel free to drop your questions in on the Q&A tab during the course of the presentation, and even out of the presentation, questions can be posted. So without any further ado, let me get started with the presentation. We have a few slides to run through. So equity as a long-term asset class. I hope my screens are visible.
Yeah, go ahead. Visible.
Yes. So I would like to start this presentation with this quote. It goes as, the realm of investments, what is perceived as risky in the short run is usually the less risky option in protecting and growing your wealth in the long run. And in the case of equities globally, as well as in Sri Lanka, the above statement is particularly true. And I say this because of a number of reasons. First and foremost, equities, when you buy stock, you're essentially buying a part ownership in a company. And unlike most of the other asset classes, with equities, these are run by able management in most cases when it's a good stock. So it's agile to changing economic conditions, be it a phase in the economy where the economy is expanding, or if there is a black swan event, or if there is a recession, equities are agile. So it's an asset class that provides agility. So this has technically allowed equity investments to sort of outperform other asset classes. Secondly, it's an inflation. So inflation is basically a general increase in price levels. And what we've seen with a bit of a lag or with a transition period, when there is inflation in the economy, it tends to basically result in better revenue top line, because the price increases in the general economy is reflected in revenue over time as prices increase for products and services. And this tends to flow through to your earnings. So with a time lag, equity market has always adjusted to higher inflation in economies with inflationary pressure. So it's provided protection against inflation. And equities have also proven to be a good currency debasement hedge, especially in frontier markets and emerging markets. And in the context of Sri Lanka, we've seen the currency sort of weaken about 6 to 7% on average in the long run. And in such a scenario, equity provides you a hedge against such currency debasement. You could have a portion of your equity allocation towards export-oriented counters which earn USD, or which have exposure to USD assets. So this basically allows you to protect against the weakness of the home currency, or in this case, LKR. And finally, equity also gives you return in terms of passive income through dividend yields. One thing that we also need to notice with dividend yield is that you might get 10 to 15% as dividend yield on current market prices. But when you buy stocks and hold it for a longer period of time, your purchase price doesn't technically change. But companies continue to evolve, their earnings improve, and the dividend payouts improve, meaning that 10 years down the line, 15 years down the line, for the cost of your equity investment, you could be earning a substantially higher dividend yield in comparison to what's stated in the market. So through all these measures, equities has proven to be a higher return asset class, and it has provided a good hedge against some of these risks that you as an investor would encounter when you invest in the long run. Let me just kind of summarize all that I said in terms of actual numbers and how equities have done in the local context, we basically compared returns over a 15-year period from post-war up until now against all possible investable asset classes for a Sri Lankan investor. We sort of left out real estate because it's not really liquid investment. It's not something that you can liquidate whenever you require. When you compare all the other asset classes, equity has been the best performing asset class, providing a compound annual growth rate of about 14% during this 15-year period. Other popular investments, such as fixed income securities, be it treasury bonds, bills, and the fixed deposit rate. As a proxy, we've taken the average weighted fixed deposit rate. They have provided a return in the range of 11 to 12% on a compound annual growth rate during this 15-year period. And during this period, the USD, as in the Sri Lankan rupee, has weakened roughly about 6%, as USD has strengthened about 6% on an annual basis during this course period. So, like I mentioned earlier, equities has provided you a hedge against both the weakness of the currency as well as outperforming other traditional asset classes such as fixed income securities, where you get a stable return. And the closest in terms of returns during this 15-year period has been gold, but gold that has been reflected in terms of healthcare terms, as gold has not only benefited from overall gold prices going up in USD terms, but has also benefited from the healthcare weakness. Moving on, I would like to discuss about risks in investing in equities, because there's a fair bit of misconception about equity risks and how it could be managed. People believe that when you invest in equities, you might lose all your capital, which is true, but these risks can be managed effectively. And rightly so, equities is placed on the higher end of the risk-return trade-off. However, when you understand the risks involved with investing in equities, you can take countermeasures to protect against some of these risks. So listing down some of the risks that you may face as an equity investor, there is no guaranteed return with equities, right? Like when you invest in fixed income securities, you will get a stable return. However, with equities, you wouldn't know exactly how much you would earn 1 year down the line. So the returns are not guaranteed. And returns can be fairly volatile within a short period of time, right? We did look at long-term returns, which is a very good 14%, but within 6 months, 1 year, returns can be quite volatile depending on the economic conditions that are prevailing. And equity investments tend to underperform other asset classes during macro weakness. When there is weakness in the economy, it tends to affect equity returns quite aggressively as opposed to some of the other asset classes. And when you invest in equities, you are basically the holder of last claim in the event the company goes bad or there's a bankruptcy. So there is a possibility that you might lose all your capital if you invest in equities. But although we have all these risks, let's look at some ways how we could mitigate some of these risks. So first and foremost, we spoke about how returns are not guaranteed. What you can do is you can allocate a portion of your investments towards high dividend yielding counters. So this provides you on an annual basis or even on a quarter. Some companies provide you quarterly dividends. Some of them give you semi-annual dividends. So you will generate a stable, steady stream of cash flows. And this would take away some of that. You would get some level of guaranteed return with holding a certain section of your portfolio in high dividend yielding counters. Secondly, in terms of managing the volatility with regards to equity returns, within your equity portfolio, rather than concentrating your exposure to a few names, you could look at a more diversified portfolio. You could have a list of 10 to 15 stocks, probably kind of diverse around different sectors, which are not really affected by the same risks or company specific or sector specific risks. So you're diversifying away some of that risk, some of that volatility that is attached to investing in a few number of stocks or a few industry specific stocks. So you can look at holding a diversified set of stocks. Thirdly, when it comes to macro weakness, how you can manage that risk is through holding a multi-asset portfolio or constructing a multi-asset portfolio. This would allow you exposure to not just equities. Equities will be a part of your overall portfolio, but you'll have exposure to fixed income securities. You will have a bit of exposure to gold, USD. All of these are to some extent uncorrelated in terms of the return you generate as well as the volatility of return. So it will um, allow you to earn a risk-adjusted return that's better than sometimes even a concentrated portfolio. And finally, when it comes to protecting yourself from events like bankruptcy, it's extremely important that before you invest in a stock, you need to spend as much time as possible understanding the fundamentals of the stock, build up conviction as to why you want to hold the stock, and then once you buy the stock, you need to proactively manage your positions. It doesn't mean that you need to look at the market every day, but at least every other week or once a month, you need to get a sense of what's happening with the stock that you're holding, as well as read about the financials and be updated, so that if you feel that the financials or the fundamentals of the company, not just 1 or 2 quarters, but consistently, if it's deteriorating, you can take the necessary countermeasures to ensure that you do not lose all your capital and you're managing that risk effectively. Moving on to the next section, let's talk a little bit about stock selection. Is a very important component, especially if you're managing your equity portfolio on your own. So we believe that in the short run, stock prices to a great extent are driven by sentiments and news flows. In the short run, the prices move up and down purely based on the demand and supply factors of the share more than, I would say, the fundamentals of the company, right? So if there is quite a bit of supply, then the share prices can come down. If there's quite a bit of demand, the prices can move up. So in the short run, uncertainty, the news flows, the new events that are happening could significantly impact the price of a share. But however, we believe in the long run, mainly there are only two factors that drive the value of a share, right? And price basically gravitates towards the value of the share. And in terms of the determinants of these two, the value of the share in the long run, we believe we would link it to the earnings that's generated by the company underlying the stock, as well as the cash flows that are generated by this company. So there are a few factors that we've sort of narrowed down that give some telltale signs in terms of a stock that's about to show good performance in terms of price. And this is also historically proven with empirical evidence. Some of these factors are major determinants of share price movements, both in the short term as well as in the long run. So in terms of these factors, first of all, you need to read enough about the company to understand the product or the service that the company is offering, and whether that particular product or service has a good market fit, and whether it's a better product than the service or service that's been produced by a competitor or a competitor at that particular point in time, and whether it provides the business a competitive edge as opposed to the other competitors, right? And it's also important that the company is focusing in an area of the market that has a long runway of growth. A long runway of growth kind of ensures that the company has enough room to grow for the foreseeable future, and they're able to dictate within that industry and able to kind of safeguard their margins. And thirdly, it's also important that the company has a good track record of earnings and cash flow generation. And it's not merely about growing earnings, but the company should also be able to beat expectations that are set by the shareholders, as well as analysts who are covering the stock, right? Who are basically looking at the company's fundamentals on a quarterly basis. The company should be able to outperform those expectations. And another thing that's very important if you're looking at equities as a long-term investment is to get a sense of the management of the company, right? Whether the company's management is capable, whether they are agile enough to take countermeasures when things don't go right, and whether the company is ethical. This would allow the company to mitigate any litigation-related issues or any ESG-related issues. And when there's a good management that is working for the best interest of the shareholders, it tends to reflect positively on the share price in the near term as well as in the long run. And gearing is also a very important element. You would ideally want, gearing is not essentially a bad thing, but you need to kind of be assured by the fact that the company is not overly geared. Because when macro conditions change, when a company is overly geared, it could severely impact their earnings power and ability to grow their earnings. Moving on, we would also like to discuss some specific factors or factors that have historically been key to movement in share prices, upward movement in share prices. As I alluded to before, it's not just about earnings growth or sales growth, but rather the ability of a company to consistently beat market expectations on both sales and earnings that tend to drive share prices. And in terms of these expectations, also, I would like to just provide some clarity. Where you can possibly, what I mean by expectation is that you need to gauge what the market is expecting from a particular company. This is a little bit easier for the larger caps where there's a fair amount of coverage by sell side analysts. These are analysts who track the company very closely. They have connection. They talk to the management. They have a good sense of the near-term foreseeable future prospects of the company. So they have certain estimates for or projections for earnings and sales for these companies. And as an individual investor, you could possibly talk to your investment advisor and get some of these reports and read them. It's just like reading an annual report. This is another way of trying to quickly analyze a company and get a sense of their future prospects, right? And then you can look at maybe building a consensus among different analysts and the estimates of a particular company, and you can see whether the company is continuously beating expectations. And if a company is quite successful in beating expectations on a consistent basis, more likely than not, we would see that reflect in their share price as well. In terms of the factors, I would like to first focus on a rising earnings yield. So this is basically a company that's able to generate a high amount of earnings when compared to their market price. Or this could also be seen as a low PE stock. So in relation to the overall market and in relation to the industry in which this particular company is operating, if a company is able to consistently grow their earnings related to their market price, eventually when the market sentiments are right, when the market conditions are right, the share price is going to catch up. So you need to focus on rising earnings yields companies that are doing really well in terms of growing their earnings. Secondly, another factor that's helped a lot in terms of identifying near-term winners is the strong price momentum. You can possibly track price performance over the last 12 months or 6-month period and see how companies are doing in general. If a company has done well over the last 6 months and 12 months, more likely that they will continue to do well over the next 6 to 12 months in terms of share price performance. Because the market is, although not perfectly efficient, it's quite efficient in terms of identifying good stocks, in terms of identifying stocks where there is a possibility of very strong earnings growth in the near term, right? And thirdly, like I alluded to a little bit earlier, you could possibly look at companies that could, that are performing better than what is expected by the market in general. With such companies, you would see the sell side analysts possibly having to re-rate their recommendations or re-rate their projections of earnings and sales. And if the company is continuously beating expectations, this would result in an upgrade of the stock recommendation as well as target prices, which would again provide a sentiment boost for the stock. So these three elements in particular have been factors that have been attributable to most of the share price gains that we've seen across, not just in Sri Lanka, but also globally. Some of the other factors that you can keep an eye on is probably the return on equity that's generated by the companies. Any company that generates more than 20-25% in ROE over a longer period of time would normally trade at a higher multiple and at a higher valuation. So that possibly gives you an opportunity to identify undervalued picks. You can look at consistent earnings growth, like I've alluded to before. Companies that have low gearing, those might be seen as companies that are relatively safe to invest in. And even companies, especially when you look at asset-driven businesses like banks and insurance, the price-to-book ratio is something that you might want to keep an eye on. When a company trades at a significant discount to its book value, which is basically the net asset of the company, eventually there will come a time the company is able to generate enough ROE that is in excess of their cost. Eventually, the share prices will re-rate. So these things provide you opportunities or help you in identifying good stocks. Now let's move on to kind of dissecting the fundamental analysis, school of thought, as well as technical analysis. So basically, the best way to look at both, for example, let me just quickly give you a definition of both. So fundamental analysis is where an analyst sits down and looks at a company as well as the overall macro economic factors of a particular index, right? So you look at how the macro is looking, how the interest rate dynamics are. You would look at the competitive environment companies finding itself in, the industry dynamics. And finally, you would also do like a bottom-up approach where you would look at the fundamentals of the company itself, whether the company is still relevant, whether the company is still able to grow their earnings, grow their revenue, and maintain their margins. And with this, you would try to identify a company that is undervalued by the market. And this basically, and with a margin of safety, this would give you a sense of what companies to invest in. It gives you a sense of what to buy, basically. So with fundamental analysis, you try to answer the question of what to buy. With technical analysis, you're essentially not really looking at the fundamentals of the business to a great extent. Rather, you're looking at the near-term demand and supply for the stock. You're looking at how the prices behave over the last 3 months, 6 months, 12 months. You're looking at the price action. You're looking at various moving averages. You're looking at the volume development in a particular share. All of this tells you when it's a good time to buy or when it's a good time to sell, right? It basically helps you answer the question of when to buy and when to sell, whether the market is overheated or whether the market is overbought or oversold, basically. So as an investor, I would suggest you sort of marry the two approaches together and combine them so that you basically get answers to two very important questions whenever you invest. You want to know what to buy, and you want to know when to buy, right? Sometimes you might end up overpaying for a stock that might be a very good stock, but you might overpay for that stock and you may not see returns for a very long period of time. Sometimes you might be too early into a good stock as well. So by combining both approaches, you might be able to better time the market, but at the same time be able to pick the right stocks. I would also like to discuss a little bit about the approaches to a self-managed equity portfolio. You can either have a concentrated equity portfolio or a diversified equity portfolio. With a concentrated equity portfolio, you're essentially having a few number of shares. Your main goal is to optimize your returns, but with higher returns or optimizing returns comes more risk. By risk, I mean the volatility of returns more than actually losing money or losing capital, right? It's more to do with the volatility of returns. So I would ideally suggest concentrated portfolios for more experienced and seasoned investors who have the time, who can put in the effort to understand a business and do somewhat of a thorough research on the fundamentals of a business, right? You don't really need to sit down and analyze the business and do your own DC yet, but you can at least you should have the time to sit down and read enough research reports and go through the annual report and spend a bit of time to basically build up conviction before you buy a company. So it's only during that, only if you have those criteria would I suggest you to build a concentrated portfolio with a few number of shares. And these should also be investors who have a very long-term mindset, who have the ability to hold their investments during bad times, because sometimes even good shares may not do well. And that gestation period in most cases might be longer than what a majority of the investors are willing to wait, right? So you need to be someone who's willing to look beyond 12 months, 24 months if you're going to have like a concentrated portfolio, because sometimes even good stocks may not immediately give you the returns you're looking for. And you should also be not too worried about volatility of asset returns. Because markets can be irrational at times. That's both a good and bad thing. The market being irrational is what basically gives you opportunities to buy great companies at good valuation. But this also means that good companies can come down. And if you're someone who's looking at your asset returns every 3 months, every 6 months, and comparing it against, let's say, fixed deposit returns or the opportunity cost of holding on to equities that's not doing well, probably a concentrated portfolio is not for you. But a concentrated portfolio is a good wealth building tool for someone who has a multi-asset portfolio and is able to just look at equity for what it is and who's able to pick a few names with thorough fundamental research and hold it, because your returns could be significant over a 2, 3 horizon. Meanwhile, for the majority of other investors who are fairly young and want to build a portfolio over the long run, I would rather suggest taking a diversified portfolio approach. With a diversified portfolio, you're holding a more number of shares. You're holding shares in different sectors so that you're not affected by anything that impacts one particular sector or one particular company per se. What this allows you to do is actively manage your portfolio, right? So you could this could allow you to basically buy into weakness, sell into strength, manage your returns a little better, manage your volatility a little better. You may not see 20% of your stock portfolio coming down within a month. So you will be able to manage your portfolio a lot better. But the downside of this is, of course, for the lower volatility of returns, you will have to be compensated with relatively lower returns. But even with diversified portfolios, it's very much possible, especially in emerging markets, very sentimentally driven markets, it's very much possible to outperform market returns and outperform your fixed income security returns. So your target should be to make higher risk adjusted returns with low volatility when you hold a diversified portfolio. So let's move on to why equity now in the current context, why someone should look at equities in Sri Lanka. There are multiple macroeconomic factors that tends to drive returns for different asset classes. And these are some factors that we've kind of collated together that sort of drives equity performance. And equities tend to outperform when some of these factors are present. And we believe right now, in the Sri Lankan context, a lot of these are present. And that's why the sort of recent movement that we've seen in equities may continue for the foreseeable future. First and foremost, equities tend to do very well during a period of economic recovery and during a period of economic expansion. In the case of Sri Lanka, of course, we went through an economic crisis, and the economy right now is in a recovery mode. And over the last 4 quarters, we've seen continuous growth in the GDP on a year-on-year basis. And for the first half of this year, we've seen a 5% growth, and it's expected that we might see about a 4% growth for the full year. In such a scenario, you would see companies printing in very good numbers in terms of revenue growth, in terms of earnings growth, right? Because with an expanding economy, you have revenue growth opportunities, you have opportunities to expand. In the case of Sri Lanka, of course, we have catch-up growth that has to happen over the course of the next 12 to 24 months. So that provides that opportunity for companies to grow their top line. And it also leads to higher corporate profitability as the volumes improve and the margins improve for companies. So it's essentially a good time to invest in equities. Secondly, equities tend to outperform when interest rates are moderate or low. So what I mean by interest rates being moderate or low in the Sri Lankan context, in average, you would look at the fixed deposit rates being around that 11 to 12% mark, even longer term T-bonds. So whenever the rates drop below these levels, be it lending rates or interest rates for deposit products, equities tend to get the benefit of that, right? It is very much beneficial when the rates go into the mid-single digits. We are not yet there, but we are on the way there. We've seen a very sharp reduction in interest rates. So when the interest rates come down, individual investors have more money that they can spend, so that increases consumption. At the same time, they have money to park in investments, right? So that again increases the demand for equities. And with lower interest rates, corporates are better off because they will see better volume growth. And from the cost side, they will see financial cost savings, especially if a company is highly geared, they will see a notable improvement in profitability. And with lower interest rates, your opportunity cost of investing in equities technically comes down. Your basically anything financial, when you value the asset, it's technically the present value of all your future cash flows. So when the interest rates come down, your valuation should also increase in line with that. And this basically results in a shift in fund flows from fixed income securities towards non-yielding asset classes such as equities and gold. We don't just see this in the local context, we are seeing this in the global context. We've recently seen an increase in gold prices, which is on the global context, and this has a lot to do with fund flows moving out of interest rate-based securities towards non-yielding assets. And equities in such scenarios do well. This is a chart that kind of shows you what I just spoke about. There's a very clear inverse relationship between the performance of the equity market and the T-bill rates, as well as general interest rates in the economy. whenever you've seen a spike in interest rates, equities have been negatively impacted. But whenever we've seen interest rates being lower and below that 12% mark, we've seen equities perform a lot better. And another factor that drives equity performance is moderate inflation, because moderate inflation allows for corporates to better manage their costs. It helps consumers with their consumption patterns, as well as allocate more money towards investment purposes. And it also allows the central bank of the country to continue monetary easing, or at least maintain their policy stance in terms of having lower interest rates. So, which is again positive for equities. And also in the Sri Lankan context, another factor that would that continues to benefit equities is that the tax treatment for equities. Equities is seen as a tax efficient as a class. Only dividends are taxed at the moment, and that to a final tax of 15%. Capital gains on equities tax free. This is in contrast to what happens with fixed income securities. We put some numbers here. Basically, with a 5-year bond, as of now, you can invest and get a return of 12%. But on a tax adjusted basis, if you're in the 36% tax bracket, your actual return is only 7.7%. With an FD, you could possibly get into a nominal return of about 9.5% for a 12-month FD, but your post-tax return is 6%. And when you compare this with the sort of historical currency weakness that we've seen, and the general level of inflation in the market, you're making a very minute real return. So equities can give you that significant real return that you're looking for. And this has also been a factor that has driven fund flows towards equities. Also, another factor that equity markets like is certainty. So we've just been through a period of uncertainty as we were getting into the election cycle, and we saw what happened in the market in the 2 months prior to the election. So markets like certainty, and at the moment in Sri Lanka, we have a fair amount of certainty with regards to at least the monetary policy side of things. There's been a clear easing monetary policy effort over the last 12 to 15 months, and the conditions are conducive for continued easing of monetary policy, especially if there are no major disruptions to the ongoing IMF program or following the general election. So even from the fiscal end, the country has done quite well. We are ahead of our primary balance target under the IMF program for 2024. We are sort of outperforming on our expectations for growth. We are outperforming on tax collections. And even for 2025, even after we have some relaxation on some of the import controls, or even after we have some relaxation on the expenditure side, we believe that we will be able to earn enough revenue to stay on track on the IMF program, which again provides certainty to the market. And certainty is something that will greatly benefit the equity market. And another one more factor, probably a very important factor, is that equities, you need to make sure that the market is not overheated when you invest, and the valuations are reasonable. We'll go through a few slides on this, but the slide here basically shows that there was a boom in the equity market locally back in 2010, 2011, immediately after the war, as the war-related risk premium came off, and the market was quite excited about all the catch-up growth that was ahead of it. But however, the market got ahead of itself. The market got quite expensive, and anyone who invested during that 2010-11 period had to basically bear through a very long period, about 10 years and 4 months, before they saw the same level of index recovery. So there was a long gestation period. So when you invest in equities, you need to be a bit mindful that you're not investing in a very expensive market or an overheated market, right? Because your gestation period could be very long. So that's the only thing that you need to be a bit mindful. When it comes to timing the market, the only time that you need to, be worried about timing the market would probably be to ensure that you don't buy the tops, right? And right now, we are not there yet. We have a long way to go before we are topped out. So that is another factor that we believe will continue to drive equity returns over the next 12 to 15 months. And we'll look at some of the charts that kind of support this view that we have about market valuations as of now. So let's quickly talk about market earnings over the first half of 2024. Uh, 2022 was a peak year. There were a number of non-recurring items. During 2022, the market benefited out of post-COVID boom, and there were a few companies that did quite exceptionally well, and the currency benefit that came in as the rupee weakened also benefited the market in 2022. But in 2023, which was basically a crisis year and a recovery year, we saw the earnings reduce a wee bit. But in the first half of 2024, we've seen a very strong recovery in earnings. As interest rates have come down and macro has stabilized, we've seen a 62% increase in the first half of 2024. And our expectation is that earnings for 2024 will be higher than 2023. We will likely see a 15 to 20% growth in overall corporate profitability, uh, driven by a number of factors. One being, the macro being stable will drive demand and top line growth. There is an expectation of lower impairments for the banking sector as the ISB restructuring comes to a conclusion. And we've also seen a significant reduction in interest rates, which basically reduces finance costs and drive earnings up. This is hugely positive for the market. Whenever you see an improvement in earnings, this gets translated into share prices. And to kind of illustrate this relationship, what I've plotted here is the movement of the ASPI against the index earnings. So this basically the earnings on an ASPI relative basis, if you can look at it that way. And you can see the flat period that we experienced between 2014 to 2019 is largely because of a lack of significant improvement in earnings. Like I mentioned, the market was a bit overheated during the 2011 phase, and it had to earnings basically had to catch up over a period of time for the market to move to the next level. And what we've seen since 2020, because of the currency weakness, because of the amount of inflation that we've seen, although we've gone through a crisis, the market has done well because the companies have been resilient, market earnings have continued to improve. And after seeing the crisis related impact in 2023, we are starting to see the earnings improve again in 2024. And this is, as you can see throughout the course of the last 10-year period here, whenever the earnings has been on an upward trajectory, the market has preempted that move. So the market always moves in anticipation of better earnings, in anticipation of future earnings, and we expect this to happen in the immediate future as well as what we are witnessing right now. And putting it into perspective in terms of price to earnings multiples, the multiple for the index overall has shrunk in the last 4 to 5 years. This is largely because of the macroeconomic weakness that we've seen. And this has meant that multiples had to reflect the increased risk that investing in Sri Lankan equities had to be, an investor had to take in order to reflect the valuations more accurately. And the market multiples used to be around 13, 14 times before this episode of the last 3 to 4 years where we've had some macro weakness. But even with the mean multiple at 11 times, the market is still undervalued at about roughly 10 times at the moment. So there is a bit more catch up to be done on the multiple front. And it can also be argued that the multiple itself should start expanding once again once we see a bit more certainty on the macro end. We've done a lot of things right in the recent past, and reaching conclusion on the ISB restructuring and a potential rating upgrade down the line could significantly take off risks that are baked into the multiple at this point in time. And as companies grow their earnings, as growth returns to the economy, that could also result in an expansion of the multiple. But even in the current context, with the current multiple, we believe that the valuations are cheaper than where historically it's been. And in a scenario where the economy is growing and the earnings are expected to improve, you would logically assume an upward re-rating of the market. Putting Sri Lanka in the context of other frontier markets, it's trading at current valuation roughly around 10 times, with a dividend yield of about 4% and ROEs in double digits. It's probably in the middle range when compared to the other frontier markets. However, given that all this risk premium that was attached to the economic crisis wanes off, you would expect, and also given that in the developed markets, as the economy is heading to a monetary easing cycle, you would expect some of those fund flows to return back to the emerging markets and the frontier markets. And Sri Lanka could be a possible beneficiary of this. Maybe not immediately, but once there is some stability on the currency, and once we see the credit rating upgrades, I think we will see the foreigners returning to the market. We haven't really seen much of that over the last 3 to 4 years, although the index has done well. This has been largely due to domestic investors playing a more active role. We would probably see foreign investors taking a more active role moving forward. Next, let's just quickly go through or compare self-managed equity portfolio as opposed to getting exposure to equities through a unit trust investment. Who should be basically the backdrop of this discussion is more towards who should look at managing their own equity portfolio as opposed to for whom is an investment exposure to equities through unit trust is more suitable, right? So in the case of self-managing an equity portfolio, ideally these should be investors who are sort of passionate about investments or passionate about equities, who can dedicate a bit of time to do their own research, read reports, be it annual reports or analyst reports, to understand the company a little bit more, build that conviction. And these should be ideally investors who can regularly keep track of their investments, maybe if not on a daily basis, at least on a fortnightly basis or once a month. They should be able to sit down with their investments and see what's happening with each of them, both from a price perspective as well as from the story itself, to see if the story is still intact. And these are investors who know their risk appetite very well. They're not over investing, or they're not investing money that they need immediately in equity. They understand their risks pretty well. So the main pros, of course, is that it can potentially outperform a unit trust investment because you're investing in a few number of stocks or investing in understanding your risk appetite better. But the cons could be the higher volatility that comes with investing directly. And if you fail to do your research, then you can possibly risk losing your capital. Meanwhile, for newer investors who do not probably have other professional interests and who do not have the time to do their own research, equity exposure through a unit trust investment might be a better option. And this would also allow them to manage their investments and grow their investments sort of hassle-free and more of a hands-off approach, as your money is managed by a professional fund manager who's looking at the market on a daily basis and who's learning about these companies and their stories. In the case of unit trust investments, of course, it can outperform market returns, especially in frontier markets. We've seen, and we would probably demonstrate this as well. It is quite possible to outperform market returns by actively managing a portfolio, even after paying your fees. On a net basis, unit trust can continue to provide positive returns. There is less time commitment, and it's more hassle-free for the investor. But in the case of funds, of course, unit trust is managed in such a way that it's not like a discretionary portfolio. It's not managed just for you, so it may not tally with your return and risk objectives. Just to take a few scenarios and just understand how much money you could have possibly made by investing a lump sum amount over a 3-year, 5-year horizon, over the long term, to see how equity markets have done and how it might be a good avenue of investment opportunity. If you had invested 1.5 million in September 21, that's 3 years ago, if you had invested this money in the CLSA equity fund, you would have earned a compound annual growth rate of 21% roughly, and you would have 2.65 million in your hand right now, like as of 30th September 2024. This has significantly outperformed the ASPI. There is no index product which is directly linked to ASPI, where you get your returns based on the performance of the ASPI. But for comparison purpose, if you were to invest in such an index, your 1.5 million would have turned into 1.9 million. This is largely due to 2022 being a relatively weak year in the market, and you would have earned about 7.7% on a compound annual basis. This compared to fixed income securities, we've taken the average weighted fixed deposit rate as a proxy. You would have 2.26 million. So you can clearly see that over a 3-year horizon, investing in a fund has been beneficial. Over a 5-year horizon as well, the same story prevails. A 1.5 million investment would have turned into 3.3 million at a compound annual growth rate of 17.2%. However, during this period, the index has also performed quite well, generating a return of 15.5%. And the fixed deposit rate has generated 11.3%, and you would have 2.5. So under both scenarios, under a 3-year and 5-year scenario, with an initial lump sum investment, you would have made a higher compound annual growth rate investing directly in the fund without having to worry about self-managing a portfolio. We've also taken another view. So this is basically over a 5-year horizon, what would have happened if you had invested a lump sum as opposed to getting into a systematic investment plan. So with a lump sum, you would invest 1.5 million. As we discussed earlier, you would make 3.31 million over the 5-year period at a 17.2% return. But if you were to invest 25,000 monthly, although you would make 2.4 million during this period because you're contributing over a period of time and you're not investing at the beginning of the period, your compound annual growth rate is a lot higher with a systematic investment plan or a 5-year horizon. This is basically because even in an uptrend market, by systematically investing over a period of time, you're able to get a better buying price and make advantage of the volatility, the index, and the fluctuations that come with it. This can be seen more prominently over a 10-year horizon. If you were to invest 3 million as a lump sum, you would have roughly about 7 million over a 10-year horizon. And that's a compound annual growth rate of about 8.4%. But if you were to adopt a systematic investment plan and invest 25,000 per month, which basically works out to the same capital as 3 million, you would have 6.3 million. However, your compound annual growth rate is a lot higher. It's about 13.7%, which is very attractive. So the conclusion from this particular slide is that if you're looking to get into equity markets and if you do not have the time to self-manage your portfolio, an equity fund might be a good option for you. And the only thing that you need to be mindful of is that you do not buy the tops, rather systematically invest over a period of time. Even if it's a small investment, you can start with something as small as 1,000 rupees, 10,000, 15,000. You need to systematically spread out your investment so that you get a good average price. You can build your wealth over a period of time. That said, as long as you avoid the tops, it's not a bad thing to invest a lump sum amount as well. The only thing that you need to be mindful is that you're not investing into an overheated market. Finally, before we conclude the presentation, we'll just quickly run through some best practices when you invest in equities. First thing, I've already kind of hit home this point a few times, but it's very important to do your own research. Everything starts with doing your fundamental research. If you're going to self-manage your portfolio, take a little bit of time, right? You don't have to do very detailed DCF modeling or anything of that sort, but just take a bit of time to read read a few years of annual report, read a few research reports, build a conviction around the buy decision, right? And have a price target in your mind based on the fundamentals of the business before you decide to buy the stock. And regularly keep tab of your performance of the portfolio. You need to, because investment landscape is ever evolving. It's not the same thing what it was 6 months ago or 1 year ago. So you need to be mindful of what's happening in the macro, what's happening in the country, what's happening to interest rates. It's very important, especially the movement in interest rates, because that directly has an impact on how your equity holdings do. So it's very important to be vigilant with regards to your portfolio holdings. Thirdly, if you're going to trade, which is a completely different approach to stock market. If you're going to trade, have a clear distinction between the capital that you're going to allocate for long-term investments as opposed to trading. This would allow you to have that clear mind in terms of not allowing a trading position turned into a long-term investment. So have that clear distinction between the two approaches, and have reasonable profit targets. Even when you invest for the long term, if you feel like the market is too excited, or if you feel like a stock is overvalued, take profits, phase out your positions, and especially during market strength, because selling into the strength will give you better prices, and it will basically give you the maximum benefit. And another point that I've already mentioned quite a bit is avoid buying in very aggressively into market tops. Sometimes it's very difficult to time the tops. So that's why maybe an SIP might be a better option, so that regardless of the tops and the bottoms, you're buying consistently and getting an average price over a period of time. But if you're going to invest lump sum amounts, ensure that you're not buying aggressively into market tops. And with a bit of experience, you will be able to identify some of these stops, because you start hearing about people talking about the money that they've made in the equity markets uh, wherever you go, basically, right? And you would see the market P is trading at significantly higher values compared to historical valuations. You would see the market being on an extended run for a long period of time, and always towards the top, you will see quite a very steep increase. And these are some of the telltale signs that you could possibly note down. That's the time where you should not. It's okay to invest, but do not invest aggressively, because it could result in long gestation periods. And finally, try to keep emotions out before you take investment decisions. Both fear of missing out, as well as fear of missing out when the market is very strong, as well as panic selling when the market is weak, would significantly jeopardize returns. So try to leave emotions out and take rational decisions. Market can be irrational, market can test your patience, but use all of that volatility and return to your advantage. And most often than not, you do well. Finally, a few slides on the track record of equity fund. I've basically brushed through some of these. The fund has been quite successful in returning long-term returns to investors with a 3-year CAGR of about 23% and significantly outperforming the SPI. And we also take risk reporting quite seriously. You can see in our newsletters that come out monthly that we don't only focus on returns, but we focus on the risk that we take to achieve some of those returns. And we've continued to outperform the market over the last 5-year period. And in terms of overperformance for the last 12 months as well, we've had an overperformance during a relatively dull period in the market. Yes, the recent past has been positive, but if you take the last 12 months, the market's been fairly dull. And even from a max drawdown perspective, the fund has had a lower drawdown compared to the market. This is a monthly performance snapshot. And as you can see, over the last 24 months or so, we've not had a single double-digit decline month, which basically shows that we've managed volatility quite well. And we've also managed to outperform the market most of these years. And with that, I think we've come to the end of the presentation. We've used a bit more time than what was initially planned for, but I hope it's useful, and I would like to take some questions if there are anything. But in the meantime, if you'd like to either invest in our funds, or if you want any other guidance, please feel free to get in touch through the contact details provided on the screen, as well as write to us to our email. And we also have provided the link to the company website, where you can see the monthly newsletters as well as the fact sheets to get a regular update on the fund performance, as well as our views on the macro and different asset classes. So with that, I'll conclude the presentation, and I'll take some questions. If there's anything, feel free to drop in your questions on the chat box.
Mohan, there seem to be some questions already, if you can take it online.
Yeah, sure. If vehicles import started or department payment started by March, what is the possibility of changing dollar price, interest rates, and stock price stability? Okay, so this question seems to be on possibility of vehicle imports restarting. And it's expected that passenger vehicle imports will start by the beginning of next year. This is sort of important as well, given that we require quite a bit of a step up in terms of revenue collection to be on the AMEP program. Obviously, in terms of the impact of the dollar, we believe that at the moment, there's quite a bit of strength in healthcare. This would likely continue until the end of this year, provided that we are heading into a peak season in terms of dollar generation, be it tourism revenue, be it remittances flows. But however, come towards the end of this year, we would likely have a deal with the ISP restructuring. So repayments will start from the beginning of next year, and vehicle imports will start, which would basically require about $1 billion initially, and might actually increase beyond that. So it's going to put some pressure on the dollar. Our view is that the USD will strengthen eventually towards the beginning of next year. And in terms of how it could affect interest rates, there will be some impact on the interest rate. But in general, we believe that in terms of the monetary policy, as long as we do not see any deviation on the ongoing IMF program, given where inflation is currently, and if oil prices also remain within the current range, provided that there are no black swan events, we believe that the direction of the monetary policy will continue to be downward. So when monetary policy is continuing on an easing path, and given the sort of fiscal discipline that we've shown the last 6 months, we are of the view that although there will be some pressure on the dollar, we do not expect it to be significant. And on the interest rates as well, in the immediate near term, there can be some upward pressure, but we do not expect there to be a change of direction, either from a monetary policy perspective or from market interest rates in a significant manner. So under such scenarios, we do not expect it would destabilize the stock market or the stock prices in the near term. There could potentially be beneficiaries of this from a USD strengthening perspective or the vehicle imports reopening. There are certain sectors and certain stocks that could benefit from this. But generally, talking about overall stock market, as long as we do not see a directional shift in interest rates, we do not believe that it's going to impact the stock prices significantly. How can we expect revenue rates and GDP growth in the near quarters? So in terms of GDP growth, our view is that the first half was very strong. This is partly because of the first half of last year having a lower base. So we've had a fair bit of catch-up growth. In the second half, we already saw some level of growth in the second half of last year. So it's not going to be as strong as the first half, but we believe overall for the full year will still be above 4%. So, and we will see, given the growth that we've seen across some of the sectors, even 2025 will be about 3% at least in terms of growth. In terms of revenue rates, we are tracking quite well. We are already beating targets, be it both revenue as well as primary surplus, based on the first 8 to 9 months of data that we've seen. We are beating both budget estimates as well as IMF targets. In terms of revenue rates, we are roughly at about 12.5% at the moment as well as GDP. We are supposed to get to about 15% as of next year, and that's where the vehicle import relaxation will come in handy. And we are already seeing the new government taking efforts to improve tax collection, which will also benefit overall revenue collection and revenue as a GDP number. Okay, even though earnings of the company raises, why some stock prices not rise or their profit show negative earnings? I'm not sure entirely which particular stock or which particular sector you're referring to, but let's say that in this scenario where you're seeing an improvement in earnings, provided that the earnings improvement is sustainable and it's likely to continue, and if it's not factored in market price, and if it's not yet reflected in market price, it's probably a good opportunity to look at, right? If you see a meaningful improvement in earnings, recovery in earnings, if it's a well-covered company and the market earnings is better than what majority of the people are expecting from the company, and if the stock price has not yet adjusted to it, that's an opportunity you could possibly look at more closely. And if you're talking about the overall market, yes, market earnings have been improving, and the market has done well. 2022 was a tough year, but in 2023 the market was up about close to 25%, 26%. This year so far we are up about 15.5%. So all of this sort of reflects the recovery that we've seen in terms of macroeconomic situation as well as company earnings. Both from a top line perspective as well as from earnings. As corporate earnings improve, we would see that trend of share prices improving, continuing. What are the best stocks to look into right now? Okay, so just a quick disclaimer that we are a fund management house, so we're not supposed to discuss about stocks specifically, given that we might have positions on some of the stocks. But you can possibly look at the top 5 holdings from our newsletter that goes out every month, which gives you a perspective of some of the stocks that we like. But in general, I would say I would keep it to a sector-specific tone. I would say there is some value still in finance companies, in BFIs, and Banks, yes, banks have seen a bit of a run in the past 1 month or so, but top tier banks are still trading below 0.6, 0.7 times book. Majority of them are trading at 0.6 times book. And this is on current. We are going to see there's a possibility of write backs on impairment, but more than that, we are going to see earnings improve in 2024 and 25 because there's going to be better private credit growth, there's going to be more loan growth, and margins may deteriorate, but it will hold up to some extent. There'll be better non-interest income growth. All of this would translate into better earnings for majority of the banks as the economy expands. So book values will continue to expand, and banks have more room to run. That said, the market overall, as well as the banking sector in particular, has seen a very strong recovery over the last 30 months. So you might want to time your entry a little bit as well. Probably the market will see a breather, or the market might not. My suggestion might be not to just completely stay out, rather start investing and reassess as you go along, and not invest too much immediately, given that there's a very strong rally that we've seen recently. So you might want to probably dollar cost average or build a position over the course of the next 3 months to 4 months, and reap the benefits maybe 12 months down the line. What are the sectors that could outperform? I broadly answered that question. In your point of view, where could ASPI reach before a major correction? Okay, so these are overheated markets. The correction can happen any moment, right? But that said, if you're having this conversation from a more fundamental perspective as to where ASPI could possibly reach, immediate resistance might be somewhere around 12,500, where we topped out around May before these uncertainties related to the political scenario came up. But from a fundamental perspective, I would assume that the market, from an earnings perspective, it has at least another 20%. It has a 20% increase that we are possibly looking at for this year. And the market is trading from a forward earnings perspective, probably around the 8 to 9 times range. So there is at least another 20 to 20% that's probably out there. But it may not happen in a straight line. You can never say market will continue to move in a straight line. You will see pullbacks, you will see near-term selling pressures that emerge. There could be other uncertainties, there could be black swan events. But in terms of I would probably put the valuation at is probably higher than where we are now. So I would probably say that this is still a good time to get into equities before the market gets overheated. The current global environment in favor of further textile and apparel manufacturers? I would say yes, because some of the data that's coming out, because if you look at apparel and textile manufacturers, their large key market, their large market is obviously the US, the West, and then probably the EU, UK, right? So we are seeing better data that's coming out of the US. The economy has been quite resilient. The Fed has started on a policy easing cycle, which will likely continue for the next few months. And we are also seeing improvement in consumer sentiment trends, which all indicate towards better order book and order book growth for apparel and textile manufacturers. And we've already seen the numbers sort of pick up in the recent export data. And from a volume perspective, you would expect there to be a recovery, and the companies to do well over the next 6 to 12 months if there are no black swan events. Does CLSA have a plan to open a whitelisted equity fund in the future? Right now, we do not have a plan of opening a new fund. However, these decisions are taken. These discussions are had periodically. We will obviously take this feedback, and we'll take it up with the management and have a discussion around it. And if there is any development, you would possibly be informed through corporate communications. Buying stocks in flag signal, what is the possibility of continuous raise? Buying stocks in flag signal. I'm not able to clearly understand if you're referring to a flag signal in terms of technical price action perspective. I would say technicals should be used largely to time the market, right? So if you believe that the strategies can vary. So someone might be looking at just purely resistance levels based on horizontal basis, or on a support basis, support on a pure horizontal basis. Different people can have different strategies. You need to continuously experiment and figure out what works best for you, and kind of follow that strategy. And if you believe that the market is overheated according to whatever the technical tools that you're using, then it's at the end of the day, it's about your conviction, right? Like basically, your fundamental analysis tells you what to buy. With the technical analysis, you need to find your answers as to what's the best time to buy and when to take a step back. So use your own strategies. In my view, I would probably say that the market's been on a continuous uptrend. We still haven't seen enough sell pressure that's detrimental to the market. Whatever sell pressure that we've seen, it's mostly been more of a rotation play from one sector to another. I would probably wait until see more distribution days, serious decline before probably deciding on uh, palpable market weakness. However, as I mentioned before, I wouldn't aggressively buy into periods of market strength like what we are seeing right now. So it's better for you to likely adopt the dollar cost averaging method. How to identify which sector to switch time to time and catch up the cycles? So this is a good question. So basically, your sectoral view is purely um, just looking at different sector different sectors at different times, right? So basically, you can track uh, broadly the economic data that comes out. You can look at sector specific data, you can look at industry analysis, and you can look at price action. Price action tells a lot about the immediate demand and supply for shares in different sectors, right? And then again, basically the share price moves based on new information that comes in. So anything that is new that is not yet factored into the market will drive share prices either to the upside or the downside. If you see a positive news that comes in and it's not yet reflected in the market, it allows you an opportunity for a rotation play, right? And the same goes for a negative news as well. So switching between sectors broadly comes down to what you can visibly see in terms of earnings for the next 3 months to 6 months. If you believe that a sector's earnings visibility is quite strong over the next 3 months to 6 months, then it provides you an opportunity to switch between sectors on that basis. There's another question that we've discussed about earlier. There's a question on the fair book value for banks where I should be traded at. So probably you need to compare probably the book value against ROEs. As a sector as a whole, majority of the banks are still returning back to their historical ROEs. And given the current scenario, I would probably put the book value, price the book value at 0.8 probably. But some other companies within the sector might be performing better than the overall sector. There could be leaders in the sector that might deserve to trade at a higher premium based on the ROEs that they're generating. So maybe the sector as a whole, I would probably put it at 0.8 until I see the ISP exchange being completed. But if I were to look at any particular stock, I would probably assign price to book multiple for that company based on that particular company's future prospects and their return earning capabilities. We'll take just one more question as we are running out of time. There's a question on the real estate sector and if this is a good time to invest. So real estate, this is a very good time to invest because as the interest rates come down, you would see more demand for real estate. But however, with real estate, I would assume that you would still probably have a bit of an holding period with real estate because um, still we are not at that stage of growth in the economy for money to easily flow into real estate. But if you're looking to invest and hold it for another year or two, then the prices are still attractive. And as interest rates continue to come down, as demand pushes up, you will see an increase in prices across real estate. And you could maybe initially look at sectors that are doing quite well. If you're looking at a commercial property, maybe look at tourism and in some of the areas where tourism is burgeoning, that might be a good play. But if you're looking at residential real estate as well, I think that the market can pick up quite well over the next 12 to 24 months. But compared to equities, the recovery or the payback might not happen as quickly as with equities, is my view. So I hope I've answered all the questions. If you have any further questions, or if you would like to get more guidance on any of the things that we discussed during the presentation today, you have the relevant email IDs and the numbers on the screen. Please take them down and feel free to reach out to us, and we can discuss a bit more in detail. So I would like to bring this session to a close. Please, thank you so much for joining in on a Saturday evening to discuss about equities. And I hope to catch you all again on another virtual education series. Thank you.